Hey everyone, it's August 11th, 2015. In this week's video, we'll review a few sectors of the market and draw on possible outcomes for the S&P 500. I want to begin by talking about the XLI or the industrial sector. Drawn on the daily chart of the index, I've highlighted an inverse head and shoulders formation that is taking shape. The neckline to this formation is 5350. Uh, if the index were to close below this neckline and trade and quickly trade back below current support price at 5250, that should be enough to push markets lower to the point where the S&P trades at least down to current support 2045. Even though I don't rely on price patterns and candlestick patterns to draw on trades, much less to pinpoint on the direction of any given index or individual names, they do help me assess current market conditions by essentially giving me a sort of a view of how investors reacted to a certain set of events in the past and how they're likely to respond in the future, given the current outcome or and changing circumstances. So for that reason, these patterns are helpful, but by no means should they be used alone as a way to draw on a trade. So for now, I wouldn't be overly bullish or overly bearish the market as a whole or the XLI. I really need to see 5350 be taken out with a vengeance and a high volume. If we look at a leading sector, which is really not saying that much like technology, it's holding up better, but again, it's not really giving us sort of any clue as to markets wanting to trade appreciably higher. The move we got in early July from the lower pivot up to the current high of the established range was mainly driven by heavyweights such as Amazon, Google, and Netflix. If you actually compare other components of the index to those three stocks, to each other, to the sector, and to the broader markets, you'll actually see, on average, relative weakness within the group. So even though the XLK is giving us the idea, or giving us the selling us the idea that it's actually showing some relative strength, as an aggregate, as a group, it's actually beginning to show some relative weakness. Again, I would not get overly bullish or overly bearish unless we clear some of the predefined price points that we've been really trading in and out of for the last 6 months. A sector like consumer staples, again, another sector showing some relative strength or some moderation to the upside once it broke out of this ascending wedge. But notice that the theme we've seen all along this year, where essentially people buy the measured move higher and immediately sell into it, has taken shape. In the XLP as well. So even though this sector is acting a little bit better and it's still trading above previous resistance, I would need to see the XLP, by all means and measures, hold the $50 level. If not, and trades back below this range, that too could be used as a signal of broader market weakness and a retest at the very least of 2045, or the current low in the S&P 500. Now, what could possibly change not only the trend but the bias momentum we've seen today in the market? I would have to say it would have to mostly would be predicated on what the US dollar does. Two things that I want to know about the US dollar. First thing is, even though the dollar is it's leading us to believe it's been acting strong since the May low. If you actually take a look at what has pushed the US dollar higher since then, it's been some of the smaller emerging market currencies. If you look at the bigger or more transacted currencies like the Japanese yen, the British pound, the Australian dollar, the Canadian dollar, all these currencies, with the exception of the Australian dollar, actually the Australian dollar has declined quite considerably this year, mainly because, again, their country is commodity based, but the strength in the US dollar is mostly predicated on the weakness of most emerging market currencies, but not on some of the heavyweights like the British pound. So for me to get overly bullish the dollar and somewhat negative equities, even if it's for a trade, I would have to see some of these bigger currencies trade lower relative to the dollar to really see further dollar strength. Other than that, I mean, it's reasonable to expect the dollar to trade in the current range between, I mean, if you're looking at the UUP, uh, the Paris shares Deutsche Bank US dollar index, between 2660 and 2440. Anything above the midway point or the 50% fib retracement at 2548 would suggest further strength and could possibly lead to some further commodity weakness and a push lower in U.S. equities. But as long as this level, 2548, is held below, I mean, you have to give the benefit of the doubt to market bulls and equities, and if you're somebody that's trying to time the market, which is a very risky business, and you really have to, you have to really be on top of everything and know your levels and whatnot. But if you're someone who's trying to anticipate the move, I would use this as a general measure of to measure your position and broader market weakness or strength. Um, as for commodities, I mean, this is a sector that's just been completely battered and bruised like there's no tomorrow. I made it clear a few weeks back how commodity weakness is really a harbinger, or is letting us know what is really to come over the next few months. Not just as it relates to stocks, or not just as it relates to markets, whether it be capital markets, debt markets, currency markets, whatever it may be, but also as it relates to the global economy. I mean, what we're about to witness over the next 6 to 24 months is going to be, I would say, earth-shattering. So, I mean, that's my opinion. It may not be worth a lot to many of you, but to see such weakness in commodities really shows you that there's a broader, bigger trend at hand that no one person can possibly battle it, and much less understand, unless they're open to the idea of understanding how domestic economies are open to the international economy, and how the different components that make up these economies ultimately interact, and how they're shaping today's world. Um, but I mean, that's another topic that I'll leave for for later discussion, or more. It's something that I discussed to some point with my subscribers. So if you're interested, by all means, join. Make sure to join the service. But as far as commodities and as it relates to price, um, here I've drawn two trend lines. Again, I'm not a big fan of trend lines, mainly because they're subjective and again they don't tell us anything new. But trend lines are helpful in one regard, and that's to measure momentum and the bias of a given trend. They're not necessarily there to give us an idea of what a trend may look like, or if a pattern was successful or not, but it really gives us a better understanding of if momentum is there or if it's not. These two trend lines I've drawn here show that there's declining momentum and negative bias to the commodity trend. Unless there's stabilization in commodity prices, it's very hard to see us trade to the highs and even above the highs in the S&P 500. I mean, ideally, market bulls would have to see these lows repaired rather quickly, or possibly risk a wider imbalance to take place, not just in commodities, but within the broader markets. So right now, if you're somebody that likes to press markets, and that's your style, your ID of how you trade the markets, then you can probably remain short commodities, but realize that if you're somebody with a longer-term perspective, the longer these commodity prices trade lower, or some of these individual names trade lower, and the bigger the percentage move, eventually the bigger the snapback is going to be. Again, this is a very tricky market, the commodity complex, to trade in, because there's no predefined bottom, at least from a pricing perspective, to really base a trade on. You have to rely on other data and other tools to really ascertain where price may bottom or top out. But whatever the case, what I'm focused on is these previous lows, or now resistance, could also be seen as a lower high on the daily chart of the Dow Jones Commodity Index. Those lows have to be repaired, otherwise there's going to be continued pressure in the broader markets. And finally, this is a market, since it's a range-bound market, right? And since there's no clear direction on where markets will trade in the near future, a lot of investors are using heavyweights or big cap names like an Google, an Amazon, an Apple to try to, again, ascertain what markets may do on a day-to-day basis. Alibaba is set to report earnings tomorrow before the bell. As of now, it's showing broader weakness, and it's actually, contesting the 52-week low as of this, the making of this video. What has me interested is the fact that Alibaba is trading, right now it's trading below the May low right before its reported earnings. As you know, the day after reported earnings, it led to this sizable gap up, which filled part of this gap, or most of it, and led again to the stock trading down to the 52-week low. Even though I don't like to give much or put much weight into what an individual name, even if it's a big cap stock, does or does not do, and how that relates to the broader markets, even though that's not my I don't believe in that much. In the current market, since most investors are paying attention to that, it's something you as a trader have to recognize and learn to accept. I mean, obviously, it's going to change once the trend, whether it be to the downside or to the upside, gets confirmed. But I would say that if Alibaba breaks considerably lower post earnings and continues to trade lower, that could be used as a sign of broader market weakness, and possibly lead to lower prices. Again, that if it happens, if a break lower occurs and it's sustained on volume, then this area was clearly an area of further distribution by firms, and it could possibly again lead us to believe markets are possibly ready to trade lower. If not, and it snapbacks to this trading range, then we're back to where we are today, essentially in a range bound market where there's no true leadership to take note of. So, long story short is, as far as the S&P 500 is, the S&P, the longer it trades between 2065 and 2078, the bigger the propensity is to price the market lower. However, it's going to take a break below 2045 to see us trade appreciably lower down to the October 2014 lows. However, the bogey I would use to measure weakness from there on out would be 1980 to 2000. In other words, if the S&P breaks below 2045 and proceeds to trade down to 1980 to 2000, this would be the new level I would use to measure further weakness if it comes down to the current lows. At what price the S&P may bottom from there on out. Again, which will much depend on where markets are then, what circumstances we have will have available in the future, and really what the Fed does or does not do with the benchmark rate, and not a whole set of factors that you'll have to take into consideration. But for somebody looking to trade market short, those are levels you want to watch for. As for to the upside, as long as the S&P trades above 2110 to 2133, the propensities again can be to price markets higher. However, it's going to take a trade above the current high, above 2133, to really see us trade appreciably higher or as high as 2181. Either way, you have to recognize how far the broader markets, not just in the United States, but in Europe and in Japan as well. Some of these more mature markets have traveled since the 2009 low and since 2003. I've shown this repeatedly in the monthly chart, and even though this may be nerve-wracking, may be a little bit confusing, and may be irritating, it's part of the process of how markets work. You can't trade higher or lower forever and not expect some type of consolidation at a higher or lower base. That's just how markets or how price is reset, either through time, through space, or through price. So with that said, hopefully next week we'll get a better sense of what markets may do, whether it be to trade higher or lower, and I will give you a little bit clearer picture as to what I'm looking for, not just in the S&P 500, but as a whole. I want to thank you for taking the time to watch the video, and I'll see you next.